Shows the pace of inflation was down in August for a second straight month. Declining gas prices are driving that decline, but inflation is still high at 8.3%. Joining us this afternoon to talk more about it is Derek Mazzarella, a financial advisor with Gateway Financial Partners. Derek, good to see you again. Thanks for being here. There are a lot of numbers here, so I want to mention a couple things. So
Sure.
the monthly numbers show the CPI rose 0.1%. Or 8.3% for the year. Core inflation, that doesn't include food and gas, was up 0.6%, or 6.3% from last year. Again, a lot of numbers. I don't necessarily understand myself what all this means. So what does this mean for the average person at home?
Sure. When you look at the numbers, they look at it from a monthly, standpoint, but also from an annual. So it really just gives you an idea of where we're moving towards. So, energy prices fell 5% this month. But we still saw significant increases in the cost of food, housing, and medical expenses went up a lot this month as well. So I'd expect that the general core expenses you have are going to remain expensive. In terms of the wages, those actually did see a slight increase, which can be good news, but it can create this vicious inflation cycle because employers will raise rates. Employees will demand raises and wages, and then they'll pass the cost off to consumers. So it'll kind of keep this inflation cycle going.
I'm curious about gas prices, and correct me if I'm wrong, but numbers have dropped, which is wonderful. But is that potentially a sign of another issue?
It can be. So the gas prices dropped about 10.5% this last month, which is, I think everyone can feel at the pump. Typically with recessions, you do see a spike in oil prices, and we did see that earlier this year. So it's definitely one thing to watch out for. And going into the winter, we're probably going to see another spike. So that's definitely something to pay attention to, because as demand rises again for heating oil and things of that nature, we will probably most likely see another rise in oil prices.
Well, as I was saying, it was the worst day on Wall Street since June of 2020, with the Dow down more than 1,270 points, I believe. What do you anticipate happening here with the stock market?
We're definitely going to feel some pain, especially in the short term. Anytime the numbers come out less or worse than expected, there's typically going to be a pretty significant drop. This is probably a little bit of an overreaction, but for at least the rest of the year, I'm going to expect us to have a good amount of volatility. So we'll see, like this week, everything was doing pretty well. Yes, today it definitely collapsed. We probably will see a little post-election bump because that historically has happened in midterm years, but definitely it's going to be really volatile for the rest of the year.
All right, lastly, I want to ask you about interest rates. Obviously, we've seen some hikes. Is that looking like that will continue to try and offset some of the other damage that's happening?
Yeah, the inflation numbers are going to really push the Fed to keep increasing the rates. Next week, they're expected to raise about 0.75%. The following rate hike is expected to be about 0.5%. If these numbers keep getting worse, they may actually increase that. But the bottom line to everyone watching this is the cost of borrowing is going to continue to get more expensive because we're really going to try and cool demand. We've already seen things like mortgage prices are forward-looking, so they've already increased their rates to over 6.5%.
Pretty wild when you think where we were over the past couple of years, really. All right, Derek Mazzarella, thank you very much for joining us this afternoon. We appreciate your time again.
Oh, thanks for having me. Talk to you soon.
Take care.